Thanks, everyone. It's nice to see some familiar faces in the audience today. I thought maybe what I would do, there is a clicker, right, is start off by kind of telling you about my journey to start Evolve ETFs. So prior to putting Evolve together, I ran Canada for WisdomTree, which is actually one of the world's largest ETF providers. Prior to that, I ran the retail business for Fiera Capital. Some of you may have heard of Fiera. They're one of the largest independent asset managers in Canada. They have roughly about $200 billion in assets under management today. Prior to that, I won't go all the way back yet, but prior to that, I built a structured products business called Propel Capital. Built it with a few partners. One of them is here today. And we built that up to about $1 billion and sold that to Fiera, which is why I went to go and run their retail business. And then going all the way back, I started something called Jovian Asset Management, which was part of a diversified financial services company called Jovian Capital. Some of you are old enough to remember Jovian. And I actually ran the asset management platform for them, and we were the ones that actually incubated the Horizons ETFs, which today is called Global X, which is also one of the country's largest ETF providers. So I intersected in the ETF business a couple of times. And then in 2016, when I left WisdomTree, I was kind of at a crossroads trying to figure out what I wanted to do next. I started getting courted by a couple of the big banks to either run their asset management platform or create an ETF platform for them. And I always say the Christmas holidays are one of the best times to clear out all the noise and think about what you want to do next, because you can put your phone away and you don't have to worry about the fact that you're going to miss anything important. And so at the Christmas holidays of 2016, I decided I wanted to do this because I could slip into that warm bath and get paid really well by a bank and manage 100+ people, or I could go and create a business again. And so right after the holidays, I decided I was going to build Evolve. Obviously, you know which decision I made. I decided I was going to go build Evolve and put together a team. And a lot of the people on my team have worked with me in previous lives or previous firms, and many of them go back 20 to 25 years. So we launched our first ETFs in 2017, as you'll see up there. We are currently just over $7.5 billion. That number is a month old. We've brought in another $250 million so far this month. And we have 30 ETFs. I'm not going to go through all of them, but what we do is we put them into a few categories. We put them into cash solutions and fixed income, equity income, and technology. I am going to talk towards the end about a few of the funds where we have had the most success over the last year, and also talk a little bit about what I foresee for this year. But before we talk more about Evolve, I thought it'd be worthwhile to give you a very quick snapshot of the ETF industry in Canada. So today, there's just over $500 billion in assets in the Canadian ETF space. There are 1,500 ETFs in Canada. We have had a growth rate in assets of about 20% per year for the last 10 years. You compare that to the mutual fund industry, which has basically been flat over that same period of time. So you can clearly see a migration in terms of investment choices, instead of mutual funds gravitating towards ETFs. To put that number into perspective as well, while we have $500 billion here in Canada, the US ETF space is about $10 trillion. So we are 1/20th the size of the US space. Normally speaking, we have a 10-to-1 rule, meaning pretty much every industry in the US is 10 times bigger than the industry in Canada. But in this case, it's 20-to-1, which means that represents, I think, an opportunity from an investment perspective to see more growth in the ETF landscape. Off to the far right, you will see the composition of our Canadian ETF industry. The majority of the assets are obviously in equity ETFs. You have just under 30% in fixed income, and then you have small portions in multi-asset crypto commodities, as well as these very famous double up, double down type of products. Here's our growth. Do I have a laser pointer on this? No? Okay, that's fine. That's fine. Here's our growth since we started in 2017. when you take a look at 2018 to 2022, it looks kind of normal, like it's a good company, it's doing well. And then we had some parabolic growth in 2022 into 2023 and 2024. The reason for that was because we brought in a lot of assets into our high interest savings account fund, or HISA. And what that fund is a cash alternative product. So we deposit with the big 6 banks. We were earning, or investors were earning, the overnight rate plus 50 basis points premium on top of that. So at its peak, investors were actually earning about 5.5% when the BOC was closer to 5% rates, which is pretty significant, obviously. And in 2022, as most of us recall, we had a very challenging equity market. We had rising interest rates, so it was the perfect storm for opportunity within these types of products, and they became the choice for a lot of investors. During that period where we had that kind of growth, I mean, we grew $5 billion in a year and a half, just under 2 years. I knew that eventually the music was going to stop, and eventually we would be back into an environment where we would have declining interest rates and an improving equity market. I just didn't know when that was going to be because nobody's crystal ball really works. I think everyone's crystal ball has a couple of cracks in it. I just didn't know when that was going to be, but it ended up being in 2024, where we started to see rate declines and we had a rallying equity market, which meant that we were going to start to see a lot of outflows from our cash product. So during 2022 and 23, what I was really focused on was making sure that we had built out enough product breadth within our lineup so that no matter where we were in the market, whatever market condition we have at least 1 or 2 products that are going to resonate with advisors and investors. Because once again, I don't have a crystal ball. I don't know what's going to happen in the market, but I do know that if I put a broad enough lineup together, something's going to resonate with the advisors. And that's exactly what happened in 2023. So I'm going to zigzag and go to this slide. Off to the left, you will see the composition of our assets at the end of 2023. We had 80% of our assets in our high interest savings account and cash solutions. It was a lot. Now, there was days where we were bringing in $100, $150 million. I mean, there was just a lot of growth. But we knew, again, that wasn't going to last forever. And so building out that product lineup, what that did for us is that in 2024, as rates came down, equity markets went up, investors, advisors decided they wanted to redeploy back into the market, we were able to capture or cross-sell or convert, whatever term you want to use, into our other funds. Because what we had going for us was that normally speaking, when you lose as much assets as we did in our high interest savings account, and by the way, in 2024, we bled out about $1.5 billion from our high interest savings account. Normally speaking, when you lose that much assets, it's because something went wrong. It's because manager went off strategy or because you had poor performance. In this case, everyone had a great experience with our fund. It delivered exactly what it was supposed to do, which meant that they were very open to taking a look at our other products because of that good experience. And so we were able to actually cross-sell. So if you fast forward to a few weeks ago, the end of 2024, we went from 80% in our HISA fund to 60%, and we started to grow in a lot of our covered call funds and some of our tech funds as well. Most importantly, for us, for Urbana, for shareholders as well, our AUM was flat. So point to point, end of 23, end of 24, we were roughly at about $7.4 billion. But because we were able to convert a lot of those assets into some of our other higher fee earning funds, higher management fee, you'll see at the bottom, year over year, our AUM was flat, but our revenue and EBITDA was up close to 40%. So it was a really good year for us, and hoping obviously that continues this year. So now I'm going to go back. This is our relationships in the marketplace. So some of you may know there's roughly about 9,000 investment advisors across Canada registered, typically with Ciro, or used to be called IROC. We never have perfect data in the ETF world, but according to Salesforce, which is our CRM, we have about 1,000 advisors who are using our ETFs today, which represents a great opportunity to obviously increase that number closer to 9,000. And of those 1,000 advisors that are using our funds, 70% of them are using more than one of our funds. All of our funds are approved at pretty much every major dealer, whether it be the bank dealers or whether it be the independents as well. And we have about 215,000 investor accounts within Evolve as well. A year ago, we had 5 funds that had over $100 million in assets. Today, we have 11 funds over $100 million. Why is that important? It's credibility. So when you start products in the ETF space, advisors are always a little concerned. Are they going to be able to get to scale? Will the firm actually shut them down because they can't get to scale? If I put my investors in, am I going to be a little bit embarrassed because I have to let them know that the fund is terminating because it didn't get size? Also, when you get to $100 million, you have a snowball effect because now all of a sudden everybody realizes that this fund has legs and other people are using it, which means they should take a closer look at it. It's a little bit of the herd mentality as it relates to ETF investing. So I'm gonna close off with just talking about some of our funds, and then I'm gonna tell you what I see as the trends over 2025. We already talked about HISA. It's our cash alternative product. It obviously continued to grow and bring in a little bit of money at the beginning of this year and last year. It's really a treadmill. There's always going to be people that feel like the market is overvalued, so they want to go to cash. But right now, there's more people that feel like they need to be in the market. Bond is a whole new asset class or product range that we launched just over a year ago. And so basically what it is we're actually writing calls on fixed income. So for those of you who don't understand the covered call space or the option space, you cannot write options or you cannot write calls on individual bonds. However, you can write calls on individual ETFs, no matter what the underlying ETF is. And so in this case, what we did was we took a look at a fund in the US called TLT. Some of you may be familiar. It's 20-year US Treasury. And iShares launched another fund called TLTW, or that's the ticker for the fund, where they wrote calls on TLT. And we looked at that and we said, this is really interesting because this is very portable to the Canadian marketplace because I know 2 things. Number 1, I know Canadians are more yield-oriented than Americans are. And number 2, covered call premiums in Canada are taxed as capital gains, whereas typically in the US, they're taxed on ordinary income. So they're highly tax efficient. The premiums are highly tax efficient in Canadian hands. So our team said, we have to launch this in Canada. Because what we were seeing talking to a lot of advisors was that in 2024, they were ready to come back into the fixed income market, but they wanted to move into long duration fixed income in anticipation of rate cuts in the US. Unfortunately, we didn't have the types of rate cuts that we were expecting in the US last year, but we still actually gathered a lot of assets in this product. Interesting fact, volatility is your best friend as it relates to option premiums. The more volatility there is, the more option premiums you can collect. The volatility of 20-year US Treasury last year was the same amount of volatility in the NASDAQ 100. So we were able to actually clip close to 7% in option premiums last year. So the yield for investors was roughly 10%. 3.5 of that was coming from the individual bonds, and the rest was coming from option premiums, which is why this product became very popular last year. We raised about $300 million in that fund. In fact, that fund and bank, which is the row below it, were the 2 funds that brought in about 55 to 60% of the total assets that we collected in 2024. What we decided to do was rinse and repeat that same strategy for Canadian fixed income because one of the areas that Canadians have a home bias towards is not just Canadian banks, but also Canadian fixed income. 72% of all of the ETF assets in Canada that are in fixed income are in Canadian domiciled fixed income. So we decided to take that same strategy and apply it to Canadian aggregate bonds. The difference is the volatility of Canadian bonds is much lower than US Treasury, which means that the option premium is nowhere close to what you can collect on US Treasury. We launched a couple of years ago, we launched the first S&P 500 and the first TSX 60 ETFs with a covered call overlay, and that's ESPX and ETSX. As I mentioned before, Bank was one of our best-selling products. It's basically just the Canadian banks plus Lifecos with a covered call overlay, but in this case, we also have 25% leverage in the fund to help hopefully amplify the returns. I'm going to talk a little bit about QQQT because it is my favorite fund. Actually, Cyber is probably my favorite fund because Cyber was the first fund that we launched. I think usually your firstborn is your favorite, even though people won't admit it. But I actually have twins, so one was 5 minutes before the other. I'm going to talk about QQQT. So this idea actually came from a lunch that I was having with the NASDAQ a couple of years ago at an ETF conference. And we were just talking about how the FANGMA stocks, or MANGMA stocks, have driven the majority of the returns of the S&P 500 and the NASDAQ 100. But then I asked them a question, which I'm very glad I did, was out of curiosity, out of the NASDAQ 100, how many of those stocks are actually technology companies? And they looked at me and they kind of chuckled and they said, it's funny you asked that because nobody ever does. It's actually only 40. Yet everybody believes when they're investing in the NASDAQ 100, they're doing so to buy tech. They don't actually fully appreciate that the NASDAQ 100 was created in 1985 to purely be a non-financials index. It became more tech-heavy with time. So while it's 40 names of the 100, it's 60% of the market cap of the NASDAQ, but I still believe that is far less than what people think when they're actually allocating to. So when they allocate to the Qs or any other NASDAQ 100, they're buying it for the tech. They're not buying it to own more Marriott, Pepsi, Costco, Lululemon, Starbucks. So I said, this is a great product. We've got to partner with you guys on this. So we partnered up with the NASDAQ for this product where we just deliver the tech component, the 40 companies within the NASDAQ 100 to the investors with the mantra that basically we're delivering to you the NASDAQ 100 you thought you were getting originally. Since we launched that fund a year and a half ago, not only has it been the best performing tech fund in Canada, it's actually been the best performing tech fund in North America. So we're really proud of that product. The last fund I'm going to mention is Cyber, and then I know I'm going to be out of time because I'm going to take 1 minute to just talk about what trends I see this year. Love this fund. We launched, as I said, it was our first fund that we launched. It's a very simple use case. It's a very different kind of technology. I consider this to be more of the utilities section of the technology industry because it's one of the few areas within tech that has a non-discretionary spend. Meaning, any bank, you name a Canadian bank, if they have a terrible financial quarter, it's not as though they're going to stand up in front of shareholders or their board and say, we've decided to reduce our spending on cybersecurity. It's not going to happen. Nor will any Fortune 500 company as well. Because everyone has seen the case study of Equifax, which had a massive breach of data in 2017, 143 million records breached. Stock dropped 35% after the announcement. Board got fired, CEO got fired, everyone's worst nightmare if you're a CEO of any major organization. So because it is an essential service within technology, we really like it because that becomes a little bit less dependent on the economy. But one last point on cybersecurity that a lot of people are not aware of is it's one of the very few areas that has a massive shortage of human capital, skilled labor. So I think I probably made this joke last time. If any of you have a child that's trying to figure out a career path for themselves, you might want to nudge them towards a career in cybersecurity because it's virtually guaranteed employment. Right now, there is 3 million job vacancies in the cybersecurity industry. So what does that's globally. So what does that mean for the fund? Because of that shortage in human capital, most companies don't have enough people to staff up. So what do? They outsource. So 75% of all the cybersecurity work that's performed for the Fortune 500 companies, for our banks here in Canada, is outsourced. If you're going to outsource it, you're going to outsource it to the big regulated, publicly listed companies, not to a private mom and pop shop operating out of their basement. So these are all the companies that are within our portfolio. We're not buying Microsoft and Google in this portfolio. We are buying companies that are purely dedicated to the cybersecurity work and purely dedicated to the companies, protecting companies' data, which I'm sure some people have mentioned up here today, data has become our most precious resource. Do I have 30 seconds to?
10 minutes.
Oh. Oh, okay. Can I cut into the Q&A with 1 minute? So let me tell you a little bit about what I see happening this year on a couple of fronts. In terms of product interest, I see continued growth within the AI space, and I'm sure some of your speakers have talked about that. I always say, every time I'm speaking to people, there are two groups that I would never bet against. I would never bet against the Canadian banks, and I would never bet against big tech, especially now under the Trump regime, where you now have this oligarch of his friends that are donating a lot of money, and he's giving preferential treatment to. I think that those are great companies to own over the long term. So that's one area. I am seeing, based on a lot of conversations that I've been having with investment advisors, that there seems to be a growing interest in repatriation to Canadian sectors. Over the last few years, everyone has been trying to figure out ways to get out of the Canadian market because the US market has done so well. You know, like, I'll give you an interesting data point. The US represents 4% of the world's population, 22% of the world's GDP, and 67% of the world's equity market capitalization. Okay? So you can't bet against that country. But I am seeing more and more investors starting to try and move back into the Canadian market, obviously moving back into Canadian banks. But we have a utilities fund that has brought in about $100 million in the last month and a half or so. So I'm seeing a growing interest in Canadian allocation, which is great. On the investing trend side, or demographic, the last year has seen a lot of growth in the Canadian market by the do-it-yourselfer investor, the online investor. There's been millions of new accounts. I believe the last data point that I saw was 3 million new accounts opened in the last year on the Quest Trades, Wealthsimples, and also the bank discount trading applications as well. 3 million accounts in Canada, and those are individual accounts. Those are, you're not counting like the RSP and the TFSA as within that. It's just, that's counting one. 3 million new accounts on a 45 million population is a lot. So this all came out of COVID, for sure, where you had a lot of people opening up online accounts in the US, buying meme stocks and things like that. In Canada, they're opening up online accounts, but they're not necessarily buying individual stocks or meme stocks. They're buying a lot of products with yield. Especially like a lot of our covered call funds have gotten a lot of traction within the DIY community. So to give you another data point, there is more ETF assets within the DIY, the do-it-yourselfer channel today, than there are held by investment advisors. What I like about it as an asset manager is that for me to have $1 million redemption from one of our funds from the advisor community requires one decision, the investment advisor. For me to lose $1 million from the DIY community typically will require 100 simultaneous decisions because you have 1,000, 10,000, 12,000 invested per account. So those assets are actually very sticky for us as well. So we are channeling a little bit more of our efforts towards the DIY community, working with social media, working with influencers, doing more advertising because it's becoming a very, very important avenue for us. I know I cut into way too much. So thank you very much. I'm happy to take any questions. Is everyone awake?
Hello. Yeah, Raj, on the QTT, triple QT.
We call it cutie.
Cutie? Yeah. All right. Yeah, I'm sure, were the returns cute last year? I'm wondering, compared to the market, and given that you concentrated on only the tech names, that must have really boosted the returns on that. So what were the returns?
So as you probably know, the NASDAQ 100 is probably the hardest index to outperform over the last 10 years, right? Because it's performed so well, hardest major index. We beat it last year by just over 11% net of fees. There was 1 year that we underperformed. So one thing I didn't mention when we were talking to the NASDAQ is they actually had already built a live index. Not a back test, because I always say you'll never see a bad back test, but a live index that had been running for 10 years. And so when they sent us that index data, it had this index had outperformed the NASDAQ 100 every year except for 2022. It's 2022, the Pepsis and the Marriotts and the Costcos did a little bit better than tech. It was an underperformance of about 6% that year. But every other year, it's outperformed. One of the biggest challenges that we have with that fund, because that fund hasn't, if you saw the list of our $100 million funds, it hasn't hit $100 million yet. And one of the biggest challenges that we have, and it shocks me, but I understand why. A lot of advisors feel like they've got enough tech exposure right now through their other NASDAQ positions or tech funds. And when we talk to them about, but this is a better way to own tech, the challenge that they have is they're pregnant with so much taxable gains in those positions that they don't want to have to crystallize it and pay that tax. So that becomes a challenge for growth for a fund like this. But it's at, I think, about 72 million, so it's getting close to 100.
Hey, I'm just a question on fee compression. So I mean, it's a bit of a game of whack-a-mole. It's been going on for years. You know, the very vanilla ETFs fees have been going down consistently, and then you guys roll out more exotic ones, covered calls, et cetera, where there's investor demand and the fees are a bit higher. So how do you find the balance? How do you see that evolving in the long run?
No pun intended. Yeah, that's a great question. So when we started the business, we knew we were not going to be able to compete with Vanguard, BMO, iShares, who had 80% and basically still have 80% of the market share. Nor do I want to. I don't want to launch an S&P 500 fund with like a 3 basis point management fee, because you need real assets in order for you to reach profitability. So what we decided to do was go into the blank space. So we launched with a lot of disruptive tech ETFs. We launched with active fixed income as well. So it's kind of a bit of a barbell approach because those are very different. But what we also realized within a lot of our disruptive tech is that niche in Canada is very different than niche in the US. Niche in the US, you can easily get to $1 billion. Niche in Canada, you're lucky to get to 100 million, which means it's very difficult to get to scale because you're only targeting 1%, 1.5% of clients' portfolios. A cybersecurity fund is not going to make up 20% of anyone's portfolio, or typically make up 20%. So what we wanted to do was try and get bigger share of wallet, but we also know that we still can't compete in that cheap beta, which is what those products are in terms of S&P 500 with 3 basis point management fee. So we went somewhere in the middle. And the middle for us became sector specific with covered calls. So you're now targeting maybe 5, maybe 10% of a client's portfolio instead of 1 or 2%. And that's where we've had a lot of our success. And within that space, to add one more point to your question, there is not really any fee compression there. The fee compression is really on the core beta strategies where, oh, you're charging 5 basis points, I can get it over here for 3, and then all of a sudden somebody else comes out at 2, and all of a sudden you're at 1 basis point, and I don't know how you build a viable business. So that is not, that's not the sandbox that we're playing in.
So you've launched a bunch of these. I'd be really curious to learn about what your process is for deciding what to target, and then your process on executing on that vision.
It's a dartboard. It is a lot of art and science that goes into it. I believe I'm the only CEO of an ETF company in Canada that actually comes from distribution. My original job in this industry was I was a wholesaler, so I was meeting with a lot of investment advisors. I think that gives us a good advantage because I'm out there all the time talking to our clients and trying to understand what their pain points are, trying to understand where the gaps and opportunities are. And because I also understand product structuring, I can kind of marry the two. And then I bring it back and talk about it with the rest of our team. We have a product development team, and we can bake up this idea. Sometimes we can take something that we see that's really resonating in the market and maybe put a little twist to it, a little bit like QQQT, right? It's a little bit like that, where you take the NASDAQ 100, you put a little twist to it and you make it better. That's kind of part of our process. And then you start getting into the structuring. If we are really keen to launch an idea, from idea to launch of the product, it's typically about 1 month. We can get it done pretty quick, clearing through the OSC and so on.